Hi, everybody. Glad you could join us here, either in person or online. Welcome to the 2025 Better Markets Academic Advisory Board inaugural conference on the state of economic and financial policymaking. I'm Dennis Kelleher. I'm the co-founder, president, and CEO of Better Markets. I'm going to talk for a bit about Better Markets, the advisory board, provide some background and context for the conference, and I'm going to conclude by introducing the advisory board co-chairs. First, Better Markets. There's a ton of information about Better Markets on our website at www.bettermarkets.org, but let me say a few words. Better Markets is an independent, nonprofit advocacy organization based in Washington, D.C. We are supported entirely by donations from the public and are beholden to nobody. That gives us the ability to speak truth to power and have independent positions. We were founded in the wake of the devastating 2008 financial crash, and the point was to make sure that the interest of hardworking Main Street Americans are the priority in the economic and financial policymaking in Washington, D.C. We have a unique team of highly qualified, experienced experts designed to be a powerful and effective counterweight to the access and influence of the financial industry and its many allies here in Washington. In short, we fight for an economy that works for all Americans, one that's supported by a strong financial system that is focused primarily on creating jobs, small businesses, broad-based economic growth, and rising living standards. We do that by making sure the laws and rules enacted and enforced in Washington prevent crashes and enable an economy that empowers all Americans to succeed and thrive. Since 2010, Better Markets has participated in more than 500 rulemakings, testified or provided expert advice in almost 100 different settings, engaged in dozens of legal cases, and done much, much more. And that's why we say better markets means better banks, better businesses, better jobs, better economic growth, better lives, and better communities. And this year actually happens to be our 15th anniversary, actually in a couple of weeks from now. So let me turn to the Better Markets Academic Advisory Board. You can find the full membership with their bios on our website, and the vast majority of them are here today and will be presenting throughout the day. Over the years, Better Markets has been very fortunate to benefit from the scholarship and expertise of many academics across the country. That, however, was on an ad hoc basis, and earlier this year, we decided to formalize our relationship with a number of the key academics focused on economic and financial issues and policies. Frankly, there are too few venues and avenues for academics interested in finance, financial reform, and the economy to regularly connect with each other and those active in the policymaking arenas. And the advisory board is a vehicle to formalize and expand that critical source of information, knowledge, insight, and expertise, while also being a policy impacting vehicle and hub. I should say that, given the range of issues and views among the advisory board members and the speakers today, no one necessarily endorses or agrees with all the activities and positions of Better Markets, and I'm going to guess that we don't necessarily agree with the positions and views of everybody else. So with that, let's go to some substantive background and context for this conference. Today is Friday, September 19th, 2025. Exactly 17 years and 4 days ago, September 15th, 2008, Lehman Brothers failed. This week, calendar-wise, overlaps exactly with that week in 2008, and I want to go back and remind us of the events of that week and some of the highlights, or lowlights, as the case may be, of those days, weeks, months, and even years. And we're here today in many respects because of those events, and much of the discussion you will hear today resonate with them. So let's start with Monday, September 15th, 2008. Many of you remember the chaos, confusion, and frankly, fear of those days from Wall Street to Main Street to Washington, D.C. This was the headline on Monday, September 15th, 2008, 17 years, 4 days ago. Lehman Brothers crashing, Merrill Lynch crashing, AIG crashing, crisis on Wall Street. It was probably an understatement. This was the next day, AIG, Lehman shock hits world markets. AIG faces a crash crunch. Uh, Treasury Secretary Paulson looking as calm as ever. Mounting fears shake world markets as banking giants rush to raise capital. I say that half in jest, but frankly, when Hank Paulson, who was the former president and CEO of Goldman Sachs, is looking like that, you know things are in pretty bad shape. This is one of my favorite headlines: New phase in financial crisis as investors run to safety. The first box says on Monday, a bankruptcy. On Tuesday, a bailout. On Wednesday, things get worse. And I don't want to belabor this, but I think it is important to remember those times. Markets in disarray as lending locks up. That was the next day. And of course, the U.S. began drafting a sweeping plan to fight the crisis as turmoil worsens in the credit markets and across America. And citing grave financial threats, officials were readying a massive rescue, which ultimately became TARP, which I'll come back to in a minute. But something a lot of people didn't know at the time that I want to talk about for a second is literally 17 years ago today, September 19th, 2008, Morgan Stanley and Goldman Sachs were effectively bankrupt and failing. Now, people didn't know it at the time, and frankly, the industry propaganda at the time and since then has denied this. But this is an internal email from the Federal Reserve Bank of New York. And it's dated September 20th, but it relates to a conversation on September 19th. And I'll read the beginning. It says, FYI, MS, Morgan Stanley called TFG. That's Tim Geithner, the president at the time of the Federal Reserve Bank of New York. So Morgan Stanley called Geithner late last night and indicated that he cannot open on Monday. Morgan Stanley advised Goldman Sachs of that, and Goldman Sachs is now panicked because it feels that if Morgan Stanley does not open, then Goldman Sachs is toast. So it appears we will definitely need to resolve both entities one way or another this weekend. So no matter what people have said since then, 17 years ago today, not a single financial institution was going to survive. They were all going down. If they didn't go down that week, they were going down the next week. Think about it. On Monday, if Morgan Stanley and Goldman Sachs collapsed, there's no fortress balance sheet, ladies and gentlemen, when everybody goes down. There's only the balance sheet of the United States of America. And that was the balance sheet that got deployed. They tried to get TARP through the House and it failed. But ultimately, U.S. did buy stakes in the nation's largest bank, $700 billion for TARP. Importantly, while the propaganda machine has made people think $700 billion was the bailout, it was the tip of the bailout. It was a tiny fraction of the bailout. And sure, the amount of money that was deployed under TARP was paid back. And yes, the United States government made its little sliver of money on it. And that is as misleading as it comes. There were trillions of dollars in bailouts, and the United States government and the American people paid dearly for that. U.S. forces 9 major banks to accept partial nationalization. I find the word forces a little humorous, given that they were going to be bankrupt. And nationalization is pretty loose here. We made some investments with some warrants. In March of 2009, the World Bank determined that the economy was the worst since the Great Depression. It's important to remember the crash of 2008 was the worst financial crash since 1929. It caused the worst economy since the Great Depression of the 1930s. That's what financial crashes do to countries. Now, this is a chart I did. Sorry, it's a little confusing. This shows the U6 broad unemployment rate. It took 10 years for the unemployment rate in the United States to return to pre-crash levels. It was September of 2017 before the broad unemployment rate returned to 2007 levels. It actually reached a peak in October of 2009, 13 months after the crash of Lehman Brothers, at 17.2%. 27 million Americans, innocent victims, out of work in 13 months. And millions stayed out of work for 10 years. And when they got back to work, their lifetime earning potential has gone down. They weren't working in the jobs they want. Their careers were gone. Their houses were gone. 16 million foreclosure filings during the so-called Great Recession. This is the damage done to Main Street, America, coast to coast, from financial crashes. The bottom line, those are the bonuses that Wall Street paid themselves every single year, including 2009 when they were bailed out, and their bonuses they paid themselves were 23% higher than they were in 2008. This shows the unemployment rate across the country, colored blue and red, according to the Republican-Democratic vote in the election of 2008. Financial crashes don't care if you're a Republican or Democrat. They don't care if you vote, you don't vote. They don't care if you're left or right, you're out of work. Texas, 14.5%. New York, 14.8%. Financial reform, financial regulation should not be a partisan issue. It should not be made a partisan issue, and people should not let those who have an interest in making it a partisan issue do so. All Americans suffer. Now, this is an astonishing fact that gets no attention. In 2018, the Federal Reserve did a study, and that study showed that at the end of 2016, 90% of the American people were poorer at the end of 2016 than they were in 2007. 90% of the American people, by 17 to 35%. So the best off American at the end of 2016 was 17% poorer than they were in 2007. Now, of course, I'm not going to talk about the 10% because we all know how well they were doing. 90% of Americans, not a better market study, not a left, right-wing study, a Federal Reserve study. And of course, the deficit and debt skyrocketed. The yellow part's attributable to the financial crash. We did a study on, Better Markets did a study on the crash in 2015, showed on a dollar amount, $20 trillion and counting in lost GDP as of 2015. The Levy Economics Institute at Bard did a study to add up all the Federal Reserve and FDIC and other government bailouts, leaving aside TARP. $29 trillion was their number. $29 trillion of money lent, used, deployed, made available, in the broadest sense, availability of money. $29 trillion. It's been criticized by a lot of people, and I say, oh, well, let's say they were wrong by half. So it's only 15 trillion. Let's say they were wrong by two-thirds, only 10 trillion. Big dollars, the balance sheet of the United States deployed to for the benefit of the financial industry, ostensibly for the benefit of the country. But if you think about the chart showing unemployment versus bonuses, ask yourself who got the benefit. Now, importantly, this was a global crash and happened all around the world. Many places, including the UK, actually nationalized a bunch of banks. This article, though, is from May 30th of 2025, a couple of months ago. That was actually when the last nationalized bank in the UK actually returned to public hands and got off the public dole, just a couple of months ago. So it's a worldwide crash with worldwide implications that destroyed Main Street Americans wherever they happen to be in the world, and the balance sheets of countries across the world are still paying for that today. Importantly, this isn't just about economics and finance. Economics, the economy, and the financial system are key pillars of our democracy and our electoral systems. And nobody talked about this better than Martin Wolf in his book called The Crisis of Democratic Capitalism. And it really shows how when the pillars of economics and financial stability are eroded, the pillars of democracy are eroded. And it really opens the aperture on the importance and the real way financial crashes resonate throughout the country and throughout the world. There's another book I wanted to quickly mention. Ours Was a Shining Future by David Leonhardt of the New York Times. I hate this title. His subtitle, The Story of American Dream, much better. Probably would have sold more. I'm not to tell him what to do. In any event, this book shows the broad history of the 20th century and how starting in about the 80s, what happened before the 80s in terms of the United States having phenomenal economic growth, the heaviest regulation in the history of the world of the financial industry, and yet in a growing middle class, and the financial industry doing well until the Reagan years, and talks about how post-Reagan years on a bipartisan basis, the financialization of the United States economy and how it led to the crash and what it really means. Quickly, this doesn't belong in the same category as those two books, but Better Markets put out a report in April of this year about Trump's deregulation on steroids and how 4 more years of deregulation on top of 4 decades of deregulation are going to lead to another crash. So with that as background and context, I know I'm not ending on a happy note. I'm not sure how to get there from here. The segue to happiness is not quite clear. But I will say this, that we are very, very lucky to have three outstanding, accomplished scholars chairing our advisory board. And I want to talk about them now for a minute. I could go on forever, but I'm only going to hit a few highlights. Their bios are on our website, and apologies in advance because I'm sure I'm going to omit some stuff. First, Jennifer Taub, a graduate of Yale University, Harvard Law School, previously taught at Vermont Law School, now a professor of law at Wayne State University in the great city of Detroit, Michigan. Her research focuses on corporate governance, banking and financial markets regulation, and importantly, white-collar crime. She's an authority on the 2008 mortgage meltdown and the related financial crisis. Her scholarship also benefits from many years in the private sector before her academic career, including at Fidelity Investments and Cendent Corporation. I have to say, she's also very active in nonprofit, nonpartisan activities and is a social media entrepreneur. You have to check out her YouTube channel, where she just interviewed multiple Pulitzer Prize winning New York Times investigative reporter Eric Lipton. Don't be missing that one. In addition to being a co-author of a case book on corporate and white-collar crime, she's written a terrific book called Big Dirty Money, subtitled The Shocking Injustice and Unseen Cost of White-Collar Crime. Although I really like the subtitle of the more recent paperback, which is Making White-Collar Criminals Pay, a fundamental problem in this country, and something Better Markets has been fighting about for 15 years now. She also wrote another terrific book called Other People's Houses, How Decades of Bailouts, Captive Regulators, and Toxic Bankers Made Home Mortgages a Thrilling Business. Although, as I like to say, and she detailed, thrilling for some, horrific for others. Second, Simon Johnson, an economist, a professor of entrepreneurship at MIT Sloan School of Management, where he co-directs MIT's Shaping the Future of Work initiative and heads up its Global Economics and Management Group. He's also a senior fellow at the Peterson Institute of International Economics, just down the road here, and good friends of ours. He was on the board of Fannie Mae until March of this year, when FHFA Director Pulte removed him and 7 other members from the board. I was going to do a few jokes here. I'm not going to. But you can check out the crazy feed if you want. Simon also co-founded the CFA's Institute Systemic Risk Council. He co-authored a fantastic book on the 2008 crash called 13 Bankers, The Wall Street Takeover and the Next Financial Meltdown. I'm sure after the next financial meltdown, people will be looking at that book and saying, why didn't people listen? He also had, for a long time, a must-read blog called The Baseline Scenario. He's written other books, White House Burning, Jump-Starting America, and most recently, Power and Progress, A 1,000-Year Struggle Over Technology and Prosperity. I could go on, but that covers the highlights. Oh, wait a minute. I got handed a note. There's one other highlight. Simon was awarded the Nobel Prize in Economic Sciences in 2024 for his and his colleagues' comparative studies in prosperity between nations. So, Simon, I was going to skip it and see if anybody noticed, but our third co-chair is Catherine Judge. Before I say anything about her background, I have to say she's on sabbatical this semester, living in the UK with her family, and she came all the way to D.C. to attend this conference. She's terrific for a million reasons, but there's one darn good one. She's the Harvey J. Goldsmith Professor of Law at Columbia Law School, and for those of you who don't know Harvey Goldsmith, he was a longtime professor at Columbia, a renowned corporate governance expert. He was a commissioner of the SEC for 5 years, considered the most influential commissioner who didn't become chair. And I have to tell you, somebody who's admired his work for a long, long time, Kate's brilliance and work is a worthy successor to Harvey, and I'm so pleased she has that chair. She's living up to that in every way. After graduating from Stanford Law School, she clerked for Judge Posner on the Seventh Circuit and Supreme Court Justice Stephen Breyer, a good Massachusetts native. And then was a corporate associate at the law firm of Latham and Watkins. At Columbia Law School, her research focuses on banking, financial crises, regulatory architecture, and intermediation design beyond finance. Big tech. She also serves as chair of the research committee of the European Corporate Governance Institute. She was a member of the Financial Research Advisory Committee of the Office of Financial Regulation, also known as OFR. Her most recent and widely acclaimed book is titled Direct: The Rise of the Middleman Economy and the Power of Going to the Source. And you should read it. It's widely acclaimed for good damn reasons. So with that, I welcome you. That's the background. Those are our co-chairs, and we're going to start the program now. Professor Judge is going to come up and introduce our first keynote speaker, who we're very honored to have today. And with that, I'll hand it off.